Hello and welcome to Thank God It's Friday. We're in a conversation with Arvind Sanger, the managing partner at Geosphere Capital Management, who joins us from New York on Skype as we await Donald Trump's swearing-in ceremony and inaugural address. But thank you so much for joining us, Arvind. Donald Trump has repeatedly spoken about tax cuts and trade wars, which has led to a stronger dollar, which again is detrimental to US trade. What is your outlook on the American economy, the dollar, and do you really think that the US equity rally is headed for some pause now?
Well, I think that there are some confusing elements to Trump's economic philosophy, if I may call it that. Clearly, on the one hand, wanting to have lower taxes and less regulations, especially rationalizing U.S. corporate taxes, is a good thing. On the other hand, trade war is a dangerously, negative thing that can spiral out of control. And on the dollar, there's been some talk from Congress about a border adjustability tax, which would put taxes on imports and give tax to exports, which would cause the dollar to strengthen. On the other hand, Donald Trump wants a weaker dollar because he thinks that other countries are manipulating their currencies to weaken them to help their exports and their manufacturing at the expense of the U.S. So I think in this mishmash of mixed messages, I don't think there's going to be any sudden clarity with the inaugural address today. So I think that those mixed messages are going to cause the market to remain somewhat range-bound after this really significant Trump rally we've had since the election, till we get a better clarity of what's coming and in which direction is Trump and his administration and Congress, which areas are they going to emphasize first?
Okay, not much clarity expected now. Donald Trump has also been talking about curbing outsourcing and bringing down drug prices, both of which, of course, have negative implications as far as the Indian technology and pharmaceutical companies are concerned. How much of all of this talk do you really expect to materialize into policy action?
Well, I mean, there is a bill in Congress to raise the minimum salary for H-1B visa applications, $100,000 a year or somewhere in that range, and that clearly would have some negative effect on some of the IT outsourcing, although it could accelerate more offshoring versus more onshoring. So the results could be mixed. Similarly, on the pharmaceutical industry, trying to talk down drug prices is a negative, but actually one of the ways you get lower prices is to encourage more generics, which would benefit Indian pharma industry. So I think the devil is in the details, and the time will tell as to how much of his what I might call the Twitter shaming of U.S. companies, how long that'll continue. Because the reality is, if they put in place some policies, let's say $100,000 for H-1Bs, that presents a framework within which companies can decide to outshore with more offshoring than onshoring, and I don't think it'll necessarily have the desired effect that Donald Trump wants. But Donald Trump is an unusual, president in terms of wanting to name and shame companies, and that's what creates a huge amount of uncertainty in investors, and which is what I think is going to worry the market, is that is he going to be happy with policy action, or is he going to want to micromanage things that don't give the desired results of what his policies are trying to accomplish?
Well, Arvind, over the past 3 months, if you consider all the emerging markets, the rupee as well as Indian equities haven't done as badly as some of the other emerging markets. My question then is, what does this mean for fund flows in India? Should fund flows return to emerging markets, will India see a relatively less allocation in that case? And are you expecting fund flows into emerging markets in general to remain subdued for at least some time now?
Well, I think for some time, yes, the fund flows will remain subdued. And part of the reason is that if there is a border adjustability tax, that could be very dollar strengthening. And that would cause emerging markets to look relatively less attractive. But if the border adjustability tax fades, and that I think would be the single biggest concern in terms of dollar versus other currencies, if that possibility fades, then I think we start to look at the emerging markets, and eventually emerging markets will come back into focus with or without border adjustability tax. But that's just one major hurdle. But absent that or past that, I think emerging markets funds flows will be driven by growth. At the end of the day, we as investors are looking for where can we find the best growth opportunities. And India still remains, notwithstanding the hit it's taken in the short term from its own demonetization decision. It still remains, if I look at the next 12 months, one of the best emerging market growth stories. So therefore, I don't think that India is going to be on the outs for any extended period of time. And you've got some catalysts. You've got a budget coming up in India. You've got GST, which is going to be rolled out hopefully sometime by mid FY18. Those are all going to provide some positive reasons, provided they go the right way, in terms of investors wanting to, visit the India story and take, the money that's been going out, starting to come back into the Indian market.
I want to pick up on the point you made about taxation, and as we know that the CBDT very recently put on hold a circular on taxation of indirect transfer of shares. Can foreign investors expect to see statements or policies from the government that could cheer foreign investors? If not, will a status quo be a dampener? And worse, what if the government makes noises about more taxes?
Well, I think that is one of the negatives, is that every few quarters you have some statement from somebody in the tax department coming up with new way to tax foreign portfolio investors. And we had an incident a few quarters ago, and then we had this incident starting in late December. And it's unfortunate that there doesn't seem to be better coordination or understanding, or having some kind of a panel that the finance ministry should put together to run ideas by investors, just to get their feedback. I mean, you don't have to listen to, you can choose to, make your own decision, but at least get feedback before putting out, frankly, half-cocked statements which cause unnecessary turmoil. So I'm hopeful that the government will try to take some decision which causes long-term, stay. An important part of the Indian investment scene is foreign portfolio investors. You can't afford to treat them like pariahs. But I think that if there is some kind of long-term capital gains tax coming, and we already know the Mauritius treatment is, going 50% this year, and then, in FY18, and then going away completely, the tax differential. But if there is something coming, there's already there's choices between the securities transaction tax and then some long-term capital gains. I would say that investors don't mind stability and predictability. What investors dislike in India, and India seems to specialize in this, is periodic arbitrary instability. And that serves nobody's purpose. It does not serve India's purpose in maximizing tax collection, and it serves no purpose in investors being able to make predictable investment decisions. So I think it's not so much that taxes are bad. A reasonable tax is, as long as it's predictable and long-term, is good, keeping in mind that if the US is going to much lower corporate taxes and lower capital gains and all of that coming out of Trump, you have to compete in a global market of capital flows and of corporate investment. So India has to keep in mind that its tax policy cannot be zigging while US is zagging, and that would make India potentially less attractive. So I think keeping those global constraints in mind, predictable tax policy is more important than whether or not there are some moderate taxes in India.
All right. But overall, do you think it is likely to be a populist budget given the upcoming state elections in India, and probably the need to soothe the rural economy post the demonetization pain?
Yeah, that is one of the concerns. Frankly, populist budget which either expands the budget deficit or invests whatever tax collections might be coming from improving growth into populism rather than into encouraging capital investment and encouraging more sustainable growth would be a negative from an investor standpoint. So when we look at the budget, obviously it's now only a couple of weeks away. We are kind of a little nervous about how much populism will get in. Obviously, in an important state election year, there will be some. and how much long-term investment and capital formation encouragement will be in the budget. So I think that's really the competing challenges that the government faces, and how they address that challenge will determine, corporate confidence and investor confidence that'll follow, because we know that corporate capex and corporate spending and corporate, driven growth has been extremely weak over the last several years, not just quarters. And so, we'd like to see elements that provide encouragement there, and not all the budget focus on, on populist measures.
When it comes to quarterly earnings so far, earnings haven't been overly upsetting, especially considering demonetization. But there's also still a few who suggest that earnings recovery will take more than just 2 or 3 quarters. Especially, you will also have, companies adapt to GST, which will also take a few more quarters after that once GST comes into play. Based on that, what is your outlook when it comes to earnings?
Well, you're right that this quarter hasn't been quite as disastrous or negative as could have been given demonetization and its potential negative effect on some demand in the second half of November and December. So in that sense, it's been a positive surprise. But I would say that as far as earnings recovery is concerned, the March quarter is still going to be a transitional quarter, because you could have some amount of inventory in the system which got pushed out in November, but which stays low. So that could be a negative. But on the other hand, I think that GST will also create some turmoil. But I think we've been through several quarters of disappointing earnings before demonetization. So at this point, I think we're seeing green shoots in terms of things like auto demand. We're seeing, coming back, again, demonetization, not short-term notwithstanding. We'll have to see how electricity demand is doing. We'll have to see how cement demand recovers from, whatever effect on real estate this has had. And other metrics that will suggest that the economy is starting to recover. And if GST causes a bit of a delay, that'll cause the market recovery to be muted till we get the full effect. So I think that remains one of the challenges, that the earnings recovery in India we continue to find excuses or reasons why it's not quite as strong as we had hoped.
What are your preferred areas of investment in India right now?
I would say that our preferred areas of investment would be, it's more bottom up than it's top down. We clearly are focused on domestic demand focused, maybe some of the, companies in cement, NBFCs, also areas, consumer demand, whether it is in an FMCG type of a sector, or it would be in the dairy area is a very interesting area to us, where there's been a lot of growth visible as you have more high grading of consumption in India. So there are specific bottom-up companies which happen to fall into these buckets. But I think, as a broad rule, we are more interested in India-facing than in US-facing. So we're not as interested in, IT and other areas where there might be more headwinds. We're more interested in, where the domestic demand and, whether the auto sector or the four-wheeler, two-wheeler, or auto components or CVs, those are other areas where we don't have current investments, but we look at with interest, because again, those are domestic-facing, where we think, again, if you're taking a 2-3 year view, there is a cyclical demand recovery that should be coming, given how weak demand was for several years. We've had 1 year of demand recovery, 1.5 years, but we think there's a lot more to go in the demand cycle.
Arvind, it was a pleasure talking to you. Thank you very much for your time.
And as for you guys, we will see you next week on yet another edition of Thank God It's Friday. Goodbye.